catch a breath and analyze what the best strategies for the investor will be in the next year or months. So what are the subjects we are going to have a look at today? Number one, of course, is the ongoing debate in the United States about the debt ceiling. Will it be increased, and if yes, under what conditions? There is also a dramatic increase in interest rates again, in particular in the United Kingdom. Then there is the GDP debate. Germany just published a tiny decline in the GDP for the first quarter. That's another subject that should be interesting. There's also the continuing saga of the UBS Credit Suisse merger. What does it mean for the investors that have their accounts with one of these two mega banks? And at the end, we also want to analyze what is the best strategy for your cash reserves. Cash will produce better returns during the next months, maybe even during the next few years. So let's start with the debt ceiling. Debt ceiling, in my opinion, is a pantomime that has been played out numerous times, and it's obviously not going to be realistic to expect a complete breakdown of the United States fiscal situation. So basically, I would not pay too much attention to that, and certainly not let this influence your short to medium-term investment strategy. More important is the increase in interest rates. In the UK, for example, there is already a little bit of panic because longer-term interest rates are around 4.5%. But given that the inflation rate is roughly 6 to 10%, depending on what you measure, it's obvious that this is not enough to kill inflation off, and you should expect higher rates. Therefore, I would avoid investing in longer-term maturities. Press reports say that there is a flood of investment into longer-term bonds, but I think a lot of people are not experienced enough and still live in the world of zero interest rates, and therefore they think 4.5% is already a bargain. So be careful and stick to shorter maturities that basically give you more or less the same return. Next, we have the German GDP number. It declined 0.1%, so basically a tiny amount. And if I look back at my investment career and my career as an economist, that goes back to the early 70s, one should remember that during the 70s, there was proper decline in GDP in various major countries. So declines of 2-3% were not exceptional. And if you think about it, what does it mean? 0.1 or 0.3 or 3% decline in GDP. It basically means that more or less the same has been produced in a country than the year before. It's maybe 0.1% less or 3% less, but does it really matter? No, it's basically just that the economist tribe, the medias, the analysts make an elephant out of a mole. They have too much time to produce reports, fill the media, bash out new comments on a daily basis, even an hourly basis, and they have to fill the media space somehow. And all that is happening is that the investor is made nervous, panicky, and therefore trapped into making wrong decisions on the basis of basically irrelevant, tiny little fluctuations in the economic data. Next subject, UBS and Credit Suisse. They are two mega banks. They have tens of thousands of investors, some of them very sophisticated. And I think it's important that each investor makes a rational analysis of the ongoing merger process. If you are with Credit Suisse, you basically just get shunted into either a department that is let's call it handling the so-called minor accounts, those below 10 million worth of assets. And then there is the high value accounts, the mega accounts, the ultra high net worth individuals. But both of them should be careful, because what does this merger mean for the private banking client? Basically, he gets moved from a hand-holding relationship advisor from one bank to the other. So this advisor is basically maybe the same if he is lucky enough to keep his job, or it's a new one. What value added does this relationship manager bring? Not very much, because he does not decide the investment strategy. He basically gets handed down from the so-called investment strategy team at the top of the pile what investments to put into each client's accounts. So basically, he's a very well-paid hand-holding, glad-handing person. And a move from bank 1 to the bank 2 will not change and move the needle for the investor. So be very careful. I'm happy to advise you if you are in a difficult situation, don't know what to do. Remember, I don't give specific investment advice, but I can help you with performance measurement, risk management, and also what is most important, controlling the costs that are associated with managing your money. Last but not least, as cash gives you very good returns again, in some cases 4 to 5%, you should really question whether it's a good idea to pay your fund manager or private banker to manage this cash for you, because there is no work involved. You could as well put the money to work yourself and save yourself the 1 to 2% management fee, because it's really you should pay for investment advice that gives you extra returns compared to the riskless rate or to the index that you are monitoring and following. But you should not pay for having cash managed that sits in a bank account. The same one could nearly say for the bond market as well. There are ways to manage the bond portion of your portfolio in a way that is very, very cost effective. Again, get in touch if you want to know more about that. But for the moment, I'm just asking you to give me a like button and maybe also subscribe and recommend the channel to your contacts and business friends. Thank you very much, and speak to you soon next week. Bye-bye.